Hi all, Andrew here again, your Labuan specialist. This week, I would like to speak on the topic of the double tax agreement between Malaysia and Australia. How are you? And I hope you had a great week last week since it was Christmas. Like last week, I will pick out a few areas of tax that is covered within the DTA between Malaysia and Australia. First of all, you have the income from land. Any income derived from the land or in connection with the land will be taxed at the location of the land. Next, I have picked out the associated enterprise. An associated enterprise is an enterprise that is associated with an entity in the other contracting state or the other country and have dealt with an arm's length transaction. What does it mean by arm's length transaction? Well, this is another big part of taxation law. It is called the transfer pricing. Well, we'll touch on that in our future videos. When I mention about transfer pricing, I happen to have an in-house expert. He's Mr. Wang or CJ. Hey CJ, take it over.
Hi, I'm Mr. Wang here from ANC Group, and we work very closely with Andrew Ang from Andrew Jai & Co. I'm a transfer pricing specialist where I actually assist my client with preparing TP documentation and solve transfer pricing issues. Well, transfer pricing is generally transaction between two related parties. You need to ensure that the prices that's being sold or being purchased by the other party is actually within arm's length. Arm's length is a very technical term. What it basically means in general terms is that market rate. So why do you need TP documentation, you might ask? So take an example for China where the tax rate is actually 25%. So imagine if you incorporate another company in Labuan whereby the tax rate is only 3%. So basically what will happen here is that when both parties, right, the China company and the Labuan company are related, what will happen is that the Labuan company will actually charge something over to the China company, and that payment, that sales is actually moved into Labuan. So you actually need a transfer pricing documentation to justify the prices which are being transacted between the company in China and the company in Labuan. The TP documentation will be used to justify the transaction between the China company and the Labuan company to the tax authority.
The Australian authority has been rather specific in this matter because they would like to include those transactions that has not been included in your yearly audits. And you may be made to include those transactions that may have been left out. Next, business income or profit. You could be taxed in the other state if you are carrying on your business through a permanent establishment. Again, I would like to emphasize this, that permanent establishment is similar to the substance requirement in the Labuan Financial Center. Dividends, however, would still be taxable at a maximum of 15% at Australia. The exception again is this: if the dividend is paid by an entity that carries on its business through a permanent establishment, those general rules do not apply. Next up, you have the royalties. Again, royalties may be taxed at both jurisdictions. However, you will not be taxed again if you have derived your dividend from a business entity with a permanent establishment, and that the royalties derived from the intellectual properties that is effectively connected with the permanent establishment. Thank you again guys for watching my videos. I hope it could continue to benefit you. If you have any inquiry at all, please feel free to drop me a message or even email me. You may find my contact details in the description below. Finally, do not forget to like, share, or even subscribe to my channel, and you may press on the bell if you do not wish to miss a single release by me. Thank you again, guys. Stay tuned and stay safe. Till the next video. See ya.